The market has a way of humbling any man who approaches it, thinking he has finally figured everything out. The moment you feel certain that you understand its rhythm, it changes the tempo. The moment you declare you've mastered it, it finds a new way to test your resolve. That is why, before I speak of charts, tools, or strategies, I want you to understand this. No technique can save a mind that has not learned discipline. And no moving average, no indicator, no clever formula can protect a trader who insists on trading emotionally instead of logically. But if your mind is steady, if your judgment is clear, even something as simple as a moving average can become a powerful compass. Swing trading is the art of waiting for the market to reveal its direction, and then joining that direction with patience rather than force. It is simple, but it is not easy. The market giveth only to those who have trained themselves to wait for the moment when probability tips in their favor. Everything else is noise. When I first began studying price cycles, I realized that the market behaves a lot like the tide. It rolls in, it rolls out, it rises, it falls, and although it never repeats itself exactly, it often rhymes with its past behavior. Moving averages made those tides visible to me long before charting became a popular tool. They reduced chaos to motion. They stripped away the temptation to chase every tick and instead showed me the underlying direction the crowd was leaning toward. But a moving average is not a prediction tool. It does not tell you what will happen next. It only shows you what has been happening with enough clarity to make an educated judgment about your next move. And swing traders must live by that judgment. They cannot be daydreamers. They cannot be impulsive. They must wait until price pulls back toward an area of value and then presses forward again. That is the mark of a steady trend, and the pullback is the moment of opportunity, provided you know how to read it. There is something dangerous about the allure of precision. Every trader wants to catch the exact bottom or the exact top. That desire has cost fortunes. It nearly cost me mine more times than I care to admit. With moving averages, you learn to forget that foolish ambition. You stop trying to predict the turning point and focus instead on recognizing when the crowd has already turned. You learn to trade the evidence, not the fantasy. Swing trading with moving averages relies on this one truth. The market trends only about 20 to 30% of the time, and when it does, a patient trader can make in one cycle what an impulsive trader loses in a month. Your job is not to trade constantly. Your job is to wait for the tide, then ride it. But look closely. Not every pullback is worth your money. Not every bounce off a moving average is a signal, and not every signal leads to profit. What separates the winning trader from the losing one is not the setup, it is the judgment behind the setup. When price rises far above a moving average, the crowd becomes enthusiastic. They get greedy, they begin to chase, but the wise trader knows that distance creates danger. I have seen countless traders buy simply because price was rising, forgetting that swings never move in a straight line. A market that rises too fast is like a man running downhill. Eventually, he loses balance. When the price pulls back to the moving average, that is the moment when fear enters the hearts of those late buyers. They worry the trend is ending. They panic. But the informed trader, the one who has watched trends unfold thousands of times, knows that the first pullback is often the safest place to step in, provided the overall trend is still intact. You must think of moving averages as regions of value, not exact levels. The market rarely respects a single line to the tick. It dances around it. It pierces it. It tests the resolve of both buyers and sellers, and it's during these tests that human psychology is most visible. A beginner sees the price dip to the moving average and trembles. He thinks the market is turning against him, but a seasoned trader sees the dip and asks instead, is the trend still healthy? Is volume still supportive? Are lower prices getting bought up quickly? Is momentum returning? Those are the questions that separate a calm decision from a reckless gamble. There were times when I lost money even though I followed my rules. That is the nature of trading. But I never lost my discipline, and that discipline kept me in the game long enough to catch the big swings. Moving averages are not for predicting the unpredictable. They exist to keep you on the right side of the market, to prevent you from going long in a downtrend or short in an uptrend. They filter out the noise. They force you to pause. And if used properly, they protect you from the worst enemy you will ever face in the market, yourself. Swing trading requires something that few traders possess: the ability to wait. Most traders find waiting unbearable. They want action. But action without purpose is chaos. I learned early on that patience is the cornerstone of profitable trading. A moving average strategy teaches this naturally. When price is far from the moving average, the disciplined trader waits. When price pulls back but shows no sign of bouncing, the trader waits. When price touches the moving average but the trend appears weak, the trader waits again. Every successful swing trade begins with waiting, and every failed trade begins with impatience. The first key to using moving averages is choosing the right time frame. Most traders sabotage themselves by looking too low. They believe smaller time frames offer more opportunity, but smaller time frames offer only more noise, more confusion, more temptation. The real trend lives on the higher time frames. A swing trader must learn to let the bigger picture guide the smaller one. A daily trend supported by a clear moving average is far more reliable than a trend on a 5-minute chart. I watched many traders destroy themselves by chasing minor fluctuations, never realizing the larger tide was going in the opposite direction. The bigger the trend, the healthier the swing. When I began understanding how moving averages reveal the phases of a trend, I noticed something else. Traders lose money not because the strategy is flawed, but because they cannot follow it. When price pulls back to the moving average, their hands tremble. They fear the market is collapsing. When price bounces and begins rising, they enter too late. Fear blinds them on the pullback. Greed blinds them on the rally. And so they enter at exactly the wrong moment. A strategy cannot fix a mind that refuses to obey its own rules. That is why the psychology behind swing trading is far more important than the technique itself. Let me give you the simplest rule that has saved me from countless poor trades. Trade only when the trend is well defined and the pullback is controlled. If the market is chopping, stay away. If the trend is erratic, stay away. If momentum is weak, stay away. There is no shame in not trading. The market will be open again tomorrow and the next day and the next. There is always another swing. The market is infinite. Your capital is not. One of the greatest mistakes traders make with moving averages is chasing crosses. They treat a cross as a signal to buy or sell without understanding the market context. But the cross is just the reflection of price action that has already occurred. By the time the average crosses, the market may have already made its move. Swing traders must think differently. Instead of crosses, watch for the slope of the moving average. If it rises steadily, the trend is intact. If it flattens, the trend is slowing. If it rolls over, the tide is turning. These small details, overlooked by most traders, are what kept me on the right side of major market moves. When a stock trends strongly, it often rides a moving average like a wave. Traders who understand this rhythm treat the moving average like a springboard. But even springs weaken with time. Every trend ages. And the longer a trend runs, the more traders begin to anticipate its end. That anticipation becomes fear. Fear turns into selling. Selling turns into reversal. A wise swing trader watches not only the moving average, but the behavior around it. When price bounces with diminishing strength, when lower highs begin forming, when volume dries up, the trend is whispering its final warning. And if you ignore that whisper, the market will shout it to you through a painful loss. I have said before that the market is a reflection of human nature. A moving average strategy works not because of mathematics, but because humans behave predictably during trends. They chase highs. They panic on pullbacks. They doubt themselves at the worst possible moment. By watching how price behaves relative to a moving average, you learn to anticipate the crowd's mistakes and profit from them. Swing trading is not about defeating the market. It is about understanding the crowd and avoiding its errors. But do not misunderstand me. You will lose trades even when you follow every rule. Trading is not about perfection. It is about endurance. The goal is not to avoid losses, but to ensure your losses are small and your wins are large. A properly placed stop below the moving average keeps you safe. A target near the swing high pays you for your patience. This balance between loss and gain is the foundation of wealth in the market. I built fortunes not by winning every trade, but by allowing the market to pay me generously during the moments when the tide aligned with my judgment. A swing trader using moving averages must treat each trade like a business decision. You enter only when the setup is clear, when the risk is defined, and when the reward outweighs the cost. You do not hope. You do not pray. You make a decision based on evidence. And once the decision is made, you allow the market to decide the outcome. Emotion has no place in the execution of a strategy. When price moves in your favor, do not grow arrogant. When it moves against you, do not panic. The moving average is your compass. Stick to it, trust it. But remember, a compass does not determine the weather. It simply points to direction. The market can still turn, and if it does, your duty is not to hope it returns, but to step aside. Survival is the first rule of trading. Profits come later. There were moments in my trading life when I believed I had finally mastered myself, but the market proved otherwise. It revealed my weaknesses, exposed my impatience, punished my arrogance. It taught me that discipline is not something you achieve once, it's a battle fought daily. A moving average swing strategy is a mirror. It reflects your patience, your discipline, your willingness to wait, and your ability to follow through. If the strategy fails, it is often because the trader failed first. If you truly want to succeed with moving averages, you must stop asking for perfect signals. No such thing exists. Instead, seek clarity, seek simplicity. The simpler the strategy, the more consistently you will follow it. A clean trend, a healthy pullback, a bounce with conviction, that is all a swing trader needs. But these simple ingredients require a disciplined mind to execute correctly. In the end, trading with moving averages is not about beating the market. It is about aligning with the market at the right moment. It is about stepping in when the tide supports you and stepping out when it turns. It is about using logic instead of emotion, patience instead of impulse, discipline instead of hope. That is the true essence of swing trading. That is the difference between those who survive and those who are washed away by the waves of speculation. If you can master yourself, the moving averages will guide you. If you cannot, nothing ever will.